have 3 EMDs who sell our products today. So how we get here? I founded the company not so much to grow the company to the size we are today, but because I had money to invest like you have. And I was working at IBM, had left IBM 3 years prior, was looking for an IBM business partner with a fellow in California, and said, gee, I gotta do something. I have this money here. I lived in Burnaby for about 3 or 4 years, so if you take a bit of an accent, it's a British Columbia accent. Because I saw prices go up from about $250 to $350 during the 3 years we lived in Burnaby in the late, early 90s. And I realized, once I bought my first condo, my second condo, my third condo, that real estate is priced like flour, or like sugar, if you want. You buy a 1 pound bag, you pay a certain price, you pay the whole 100-pound sack, you pay less per pound. So I decided after buying 3 condos that I'd rather buy the whole building because it's cheaper per unit. And I did that with the first 3 properties with my own money, and I had no more money, it was all invested in these buildings. And I started to ask friends and family to invest with me. And in about 2004, we started to syndicate buildings, and that's what we continue to do today. So we have transacted about $1/6 billion in properties, about 35 buildings. We've sold about 20 of those. All of them are worth more today than they are when we sold them. We own close to 1,000 apartments today. We have about $1 million in revenue a month at the moment, about $10 million a year. And we have about 600 investors with us today. And the asset base today is about $100 million. What we have to invest, if you want to invest with us, is a limited partnership called King's Castle LP, and we have information out at the booth right behind the wall. I'd be happy to get your name and talk to you about that further. What I want to talk about is, though, what lessons did we learn along the way, because obviously we made some mistakes too, like others, but we are still in business, unlike folks you've heard about, like Concrete Equities, or Shire, or Liberty Gate, or Foundation Capital out of Alberta, who all went bust in the 08-09 real estate crisis, and then League last week filed for bankruptcy as well, big company out of British Columbia. So there was a lot of money to be made, and if you can make money, it attracts a lot of shady characters to the business. And we certainly saw that in spades through the last 5-6 years. So one lesson I learned, and it certainly applies to real estate, and I try to teach it to my kids, which are in their early 20s, there's 5 ways to make money. The first one is you work, and most people in the room have worked, and the more you work, the more money you make usually, and the more you're educated and the better service you provide, the more money you make. But in the end, you exchange your own time for dollars. But that's a century-old, millennium-old technique to make money. And certainly, I've worked very hard and continue to work very hard. The second thing you have to do, and that's why I think here at this conference and listen to Michael Campbell, is you invest your own money. So once you work, hopefully you spend less than you make. You have some savings. The question is what you do with it. I'll talk about asset allocation in a chart here. You invest your own money. The third thing is, and again it pertains to real estate, is you invest other people's money. We listened to Chris before, he talked about mortgages and leverage. If you go to the bank and get a mortgage, that's not your money, it's the bank's money, right? You borrow the money at some interest rate usually, but you invest your own money and other people's money. In addition, you should invest other people's time. So if you invest with us, for example, we work for you. If you hire, like buy one of Chris's condos, you buy a condo, they put up a rental pool, someone does the rent collection for you, and the painting for you, and the rent collection. So you use other people's time to work on your behalf. So if you work on all those 4 cylinders, as opposed to perhaps just the first 3 quarters, because some people don't even work really hard and expect to get rich by not working very hard, you can get a long way. The book really is the 5th way, a bit like Elton John, right? He doesn't make, or the Beatles, or Bono, they make money when they sleep, because they sell you their songs. So it's called intellectual properties, or trademarks. So I have a few trademarks, and this is the book, this is the first attempt, so I collect $20 per book. You know, I make 30% of that, the rest goes to Amazon. But over time you can maybe make some money, so we'll see where that goes. But there's certainly a way to make money as well, by licensing your intellectual property. Writing a book, maybe you're a poet, maybe you're a songwriter, maybe you're a painter, maybe you're an artist. That's all ways to make money. So those are 5 ways to make money. And the first 4 certainly apply to real estate, because real estate, you invest your own time usually, you look for deals, you invest your own money, you get a mortgage usually, and you have other people collect the rents for you, paint the place, etc. Let's talk about some business lessons. I'm not a financial planner, so I cannot give you advice. So, it's the top right corner. I can give you my opinion though. So here's my opinion. If you have money to invest, you should put it broadly into 3 buckets. 10% of the money roughly should be high risk, 30% medium risk, and about 60% low risk. No one talks about risk usually. Everyone talks about I get 12% return, or 18%, or 6%, or 1%. And therefore, you got to look at the potential return, but also, of course, at the risk. So, what are some very risky investments? Well, land development with mortgages is extremely risky. Second, mortgages in construction projects behind the first mortgage, very risky. Penny stocks, gold stocks, certainly very risky. Greek bonds. Restaurants. I used to own one. I played up there, so some of my money is up there. I own some software companies. One is out of business now, but one will do really well. I also made an investment in a restaurant. Do you know how to make $100,000 in a restaurant business? Start with a quarter mine, yeah. So I learned my lesson there. But again, when you look at Earls, you look at the Keg, you look at Milestones, there's chains, you look at McDonald's, they are successful restaurant chains, so obviously you can make money if you know what they're doing. So certainly you want to put some money in that space. We don't offer anything today in that space. However, we offer something in this space, or will do shortly, which is land development with no mortgages. If you have second mortgages, for example, on apartment buildings or commercial properties, that it's also okay. It's less risky than a 100% risk pyramid up top. Or most large cap stocks, also classify them as medium risk. Probably golds, very fluctuating, euro bonds, commercial real estate, and construction projects, by and large, I would classify as medium risk. So you want to put maybe some money in that category. And then there is lower risk investments, and that's where we play today. One offering we have is apartment buildings. So most of our LPs are based on apartment buildings. It's a fairly low risk environment. That's why through the recession from 2007 to 2009 we didn't lose any money. Now we didn't make a lot either, but we didn't go out of business like many of the folks I mentioned earlier. Or if you're a lender in first position, it's a fairly low risk business. That's why banks like to take your money, pay you nothing in a savings account, but lend it out at 3 or 4%. It's good business. You know, buy several tens of billions of dollars. It's a good margin for the banks. Corporate bonds, municipal bonds, government bonds. All those are certainly low risk offerings, and you want to avail yourself to those and probably asset allocate them across a bunch of assets. Please keep in mind that the security regulation we fall under, and the NEMA guy talked about 45106, every of these investments is called risky. So even if we bought a Government of Canada bond at 1.5% and syndicated that to you, we still have to give you a risk disclaimer that says this is a risky investment. So the risk disclaimer forms you will get from folks like Scotty or the EMD reps has the same form, whether it's an extremely risky project or some with very low risk. The same form says this is a risky investment, you can lose all your money. So that's the form you will have to sign, because there is a chance that even in an apartment building with a 60% mortgage, we can lose your money. That's possible. If the market turns down, every person leaves Edmonton, which is theoretically possible, then guess what? Rents will go down. Right? Interest rates might go to 17% tomorrow. Extremely unlikely, but certainly possible. So therefore, keep in mind that the term risk really is not defined further. You need to sort of apply your own judgment what that means. And as I mentioned, we focus primarily on apartment buildings. We will do an offering probably later this year, early next year, on land. Similar story to what Chris mentioned in the LNG space. We will do a project in Cold Lake. oil sands development, very profitable, follows the same model as Mag. Prices are still very reasonable there. Okay, so 2 lessons so far, 3 more to go. Or should I say 78 more to go? This one certainly Chris took from me. And he talked about that. Sorry. Real estate is a 3-course meal. So he talked about the cash flow. That's the appetizer. But don't get hung up on the cash flow. It's not that great usually. However, he mentioned correctly that the main course is what you want to focus on. When we buy a building, and we bought a building 2 weeks ago in Edmonton for $10.5 million with an $8 million mortgage, we know exactly what the mortgage will be a year from now, 2 years from now, 5 years from now. You pay the mortgage down by about 15% in 5 years. So even in a completely flat market with no cash flow, you make money just paying the mortgage down. So the cash flow really is just there to pay your bills. And hopefully something left over at the end of the day. But if you have nothing left over, you pay a mortgage down, great, you make lots of money. Of course, we like dessert as well. And we like our equity upside. And Chris mentioned the figure 5%. I also believe in that figure. It has been higher in markets like Edmonton, where we have invested. It can be higher in markets like Yorkton, where we invested 8% a year, is very doable. Roughly in Canada, real estate has doubled every 15 to 20 years, which is about 5 to 6% compounded. And of course, you want a full course meal, right? You want your appetizer, you want your main course, and you want your dessert. And therefore, you could argue, why should we ever sell a building, just refinance and keep going? And we've been doing that a few times. One building I own half of, because I did a syndication about 9 years ago with about a dozen people, went from $5 million, and today it's worth over $12 million. The rent went from $45,000 a month to about $100,000 a month. It's a great asset to own forever. So another lesson is you want to borrow money to buy real estate. Really, in the essence, you borrow at today about 3 or 4%, and you invest at 5 to 7%. That's really what we do. It's a very simple business model. So if you buy an asset with 25% down, which is the yellow bar, and you hold it for 5 years at a 5% annual growth, which is very doable in most healthy markets in Canada, not necessarily maybe in the US, not necessarily maybe in Toronto or Vancouver, but certainly in Edmonton, certainly in Saskatoon, certainly in Fort St. John, certainly in Calgary. You make about 133% return, counting the cash flow and the mortgage pay down and the equity upside. Now that's before expenses, and obviously if you invest with us, we have to make money too. We'll take a portion of that. There's expenses, any private firm has overhead that has to be deducted of that. And if you invest in markets which have higher growth, which is certainly possible, like in markets like Calgary, where we bought a building 3 years ago for $14.5 million, today it's worth 20. So it went up about 30% in 3 years. That's a 10% growth. So 8% a year is not what you usually get, but if you pick the assets and the timing properly, that's very doable. The return is almost 200% on your money. And it's very doable consistently. So we don't want to just buy one building and get lucky, right? Once in a while, you get lucky. And we have certainly bought buildings where we get lucky and had a 200-300% return. That's not consistently doable, but getting 3, 4, 5% a year upside is very consistently doable in many markets. And then, of course, many of you invest in stocks. Of course, you follow Michael Campbell. He's a believer in hard assets and real estate and resource-based stocks. This is the TSX over 12 years. You know, it goes up and down. And on average, if you had invested in 2000 and till today, you would have made about 4% a year. That's average. So if you invest in stocks, I think that's a good number to use to plan your retirement. You can get 4%. That assumes not mutual funds. It assumes you pick the stocks yourself. Maybe ETFs with low figures, maybe an index fund. If you pick the wrong entry point, perhaps the year 2000, or you pick one of those peaks over there, there, flat is also not uncommon. Now, if I were a great stock picker, I wouldn't do real estate investments. I'd offer a mutual fund because I pick stocks well, but I don't pick stocks well. I have some money in the stock market, but most of the money is in real estate. So you take your 4% a year, and now you deduct your 2% MER, your management expense ratio. 2% is what you should expect in a mutual fund going forward. So don't expect 6 or 8%. So if you have a financial planner who projects 5 or 6%, that's not doable. One chapter in my book is called Wealth Planning is about the wealth of the planner. Right? It's about assets under management collecting 1 or 2% from you, regardless of the performance. As long as you stick with them, they make the 1 or 2%. So it goes like this: the bank makes money, the brokerage house makes money, the broker makes money, but you don't make money. But hey, 3 out of 4 is not so bad. Let's keep going, right? That's why there's so much advertising in the media. It's a good business for the banks and the brokers. So be mindful. Of course, brokers have to get paid. Sales is extremely important. I worked for IBM in sales for 3 years. Salespeople are very relevant to any corporation. It's very important, but it has to be not at your expense in the end. You have to make money as well. So here's some prices in Edmonton, for example, over the last 15 years. From the mid-90s to today, we've seen about a 5 or 6% growth per year. So what used to be about $25,000 a unit in Edmonton today is about $100,000 and $105,000 a unit. As you can see, there was a big spike in 07. We sold half of our Alberta portfolio in 07, and that's why I live in a fancy condo in Vancouver now. And then we didn't buy anything in Alberta. We moved to other markets and did fairly well, although we made some mistakes doing that as well. And we started buying in 2010 in Calgary and in Red Deer in Edmonton, and continue to buy in Edmonton right now because we think Alberta is booming. I have a bunch of charts I won't talk about tonight, this afternoon, because I don't have the time. But Alberta is still a good market. But similar price developments in North Vancouver, for example, Surrey, Burnaby, or in the suburbs of Vancouver. Similar price point developments where prices doubled over the last 10 years or so. So therefore the recommendation to you is, why not consider a private apartment LP where the target ROI is about 10%. That doesn't mean we guarantee anything because we can't. A, by law, we can't guarantee anything, and B, we don't know what the market will be in 5 years. I think it's going to be higher. So if I buy a building today at $100,000 a unit, I think it's going to be about $125, $130 a unit. And plus, I'm levered. I think we can deliver that. But I don't know what the market will be in 5 years. I'll make some assumptions, hopefully. So it's based by income-producing apartment buildings. We offer either 5% cash flow, which we pay quarterly, or you take 6% in units. We usually ask people, which number is bigger, 5 or 6? And most people, after some thinking, say, yeah, 6 is bigger. And therefore, about 90% of our investors take the DRIP option, take the paper as opposed to the cash flow. But as people get older, including myself, people like the cash flow. So we see more and more people take the cash flow option now, because you want to, fund your retirement. And it's RSP eligible, and RESP, TFSA, and it starts at $20,000. So, and we believe it's a good asset class for that bottom of the pyramid. We will have an offering, as I mentioned earlier, in the land development space, in the center, in Cold Lake. We haven't got our act together yet, quite yet. We own the land already. It comes out of a foreclosed property of Liberty Gate, which went out of business about 3 or 4 years ago. I was an investor at Liberty Gate. I lost $150,000 of my own money investing with this guy. He raised $30 million in 6 projects, and all the money is gone in 6 projects. 2 in Regina, 2 in Edmonton, and 2 in Cold Lake. So I was really pissed off, so I decided to buy the land instead. So we intend to spin that off as a separate offering probably later this year, early next year. But the focus right now, and where 90% of our money is invested, is in this fairly safe asset class called apartment buildings. Fairly low volatility. It's a growth-oriented, tax-advantaged investment, because I can flow the capital gains to you. An LP is essentially a JV on steroids. So if the two of us do a joint venture, I can flow out the losses and the gains to the two of us, and the LP takes it to the next level. So if you sell a building for 50% gain, that will come back to you as a capital gain, as a tax advantage. It's like owning it yourself, basically. And it's a fairly hassle-free investment. So we take the hassles from you, and that's where we get the gray hair, and you don't. One of the trademarks I created was become a landlord without the hassles. So that's what we offer to you. So here's my prayer to you as a Christian in the marketplace, as a good, caring Christian capitalist. Be on your guard, stand firm in the faith, be men of courage, be strong, do everything in love. So here are some final thoughts. Every day is a gift. I had several people die on me. I have a dedication in the book to several people, one of them which was my favorite on-site manager of the large building I mentioned earlier in Edmonton. She passed away of cancer in the spring. She was diagnosed in the fall, and within 6 months she was dead. So she was in her late 50s. So every day is a gift, use it wisely. So if you have someone at home you love, maybe forgive them and move on and tuck in. The real estate roads are paved with gold, especially in Alberta where we live here, but you actually have to bend over to pick it up. So some work is required. I also believe real estate is like a rose, so enjoy the rosebud, but be aware of the thorns. It's kind of prickly, and I've talked about these thorns in the book. There's many more lessons we learned, so I don't have time today to talk about them. The book is not available at our booth because I'm unable to collect cash and account for it. So you have to go to Amazon to get it. You'll have probably a Kindle version and a Kobo version shortly. The next trademark I have is this one. Don't wait to invest in real estate. Invest in real estate and wait. So the message here is just get going. I own a condo I bought in 1998. It's the real estate I own the longest now. I paid $80,000 for it. I've seen it once in the year 2000. And the rent today is about $1,000. And I get a statement every month. And once a year I carry it to my accountant and say, please file a statement. And every 5 years the bank phones me and says, hey Mr. Buyer, the mortgage up for renewal. What would you like? And I just renewed the mortgage at 2.6% for 5 more years. So I mean, it's really nice to own, and it's very hassle-free. And when you check in an old folks' home, may you own it free and clear. So we have a booth, and Christine is there, and we have a booth. So if you put your name into our booth, we'll put in a drawer for a gold coin, 1 ounce, 1/10 ounce, sorry. Because the other phrase is, apartment buildings is like gold with a yield. Right? It's better than gold, actually has societal benefits, and there's a yield. So invest with us and buy my book, and thank you for coming.